So maybe you're about to open a TFSA, a tax-free savings account, but now you're wondering, okay, what exactly do I buy in here? And that's where a lot of people get stuck. The TFSA itself is not the investment, it's just the account, sort of like a container that you can fill with investments. Then inside that account, you still have to decide what to actually invest in. So in this video today, I'm going to show you the simple 3-layer strategy that I use to invest in my TFSA to grow my wealth faster. Quick disclaimer guys, this is financial education and entertainment only, not financial advice. Always do your own research before making any financial decisions. And just in case you haven't opened a TFSA yet and you are wondering how you can do that, I just want to share with you that I've been happily using Questrade for about 2 years now, in addition to another platform I'm using, and I'll leave my link below in case you want to check out their current cashback offer. Now, since you've clicked on this video, I'm assuming you've already decided that a TFSA makes sense for you. And for most people, opening a TFSA is a great decision because it's very flexible. Quick recap, your money can grow inside a TFSA without being taxed along the way. Any interest, income, dividends, and capital gains that result from your investments within your TFSA will not be subject to taxes. And even when one day you sell your investment and withdraw your money from your TFSA, it will not be taxed, unlike when you withdraw money from your RRSP, in which case you will have to deal with taxes. Now, that flexibility is a big reason why so many Canadians use the TFSA to build wealth. Now, in this video, I'm not going to dive deep into TFSA basics, so if you still need help deciding which account or accounts are best for you, TFSA, RSP, or FHSA, you can join me in this video later. But here's the key thing for today. The TFSA is just the container. And inside that container, you can hold different kinds of investments, including stocks, bonds, GICs, mutual funds, and ETFs. Not crypto though, at least not at the moment. But since there are so many investments to choose from, how can you decide what to actually invest in? Now, there are many different ways to do this, but in today's video, I'm just going to share with you my personal approach that I use, since my goal is to grow my wealth a bit faster. And I also have a medium to high risk tolerance, so this approach that I'm sharing today would also be suitable for someone who has a medium to high risk tolerance as well. On this note, in case you're someone who wants zero risk, then this video is probably not for you. Now, before I break down the 3 layers for TFSA investing that I use, there's one important assumption I need to make. The strategy that I'm using assumes that you already have at least some emergency cash set aside. If you don't have any emergent cash at all, you will want to set up your TFSA a bit differently. I'll come back to that later. Now, assuming you do have emergency cash set aside, here's the simple way I think about what to put inside a TFSA. Layer 1 is core. Layer 2 is growth. Layer 3 is optional for high volatility investments. That's it. 3 layers, 3 different jobs. And once you start thinking this way, deciding what to put in your TFSA becomes much simpler. So let's start with layer 1, the core. This is the foundation. The job of the core layer is to give you broad exposure to the market, take a reasonable level of risk, and ideally grow your money faster than inflation over long periods of time. Of course, returns are never guaranteed, but this is the layer that is designed to capture the general growth of businesses and economies rather than relying on a small handful of very specific bets and industries. That's why this layer is the biggest part of my TFSA stock portfolio. Let me show you on the Questrade investment app over here. One of my favorite investments that I have in my core layer is the VFV, which gives exposure to the S&P 500, the US's 500 largest companies. But it doesn't have to be the VFV, not at all. There are other ways to build a core layer depending on how simple or how diversified you want it to be. For example, the VUN gives you broader exposure to the US stock market beyond just the biggest names. XEQT or VEQT are also all equity, but give you global diversification in one ETF, although still heavily weighted towards US stocks. XGRO or VGRO also give you diversification, but with some bonds included, so the ride is usually a bit less aggressive than an all-equity fund. By the way, guys, all the investments I just mentioned are ETFs or exchange-traded funds, and I assume you're more or less familiar with them. In case not, I have a video up here explaining what ETFs actually are and why I like them better than stocks. Now, next you might ask, so which should I choose? Which ETF is the best? And here are my 2 answers. First, It really depends on what your goals are. You can ask yourself these questions. Do I want a very simple one-ticket diversification, for example, just US exposure, or do I want global exposure? Also, do I want 100% equities because I can handle bigger swings, or do I want some bonds included because I know I'll sleep better when the markets get rough? And here's my second answer and the important point. Yes, there's a lot of fine-tuning you can do to choose the perfect investment, and even people claiming to be experts can be wrong on this, but I think that the most important thing is to be invested. It is better to make a slightly less optimal decision. Let's say you pick ETF A instead of ETF B and it grows a bit slower, but it's still better than procrastinating and not investing your money at all and losing it all to inflation. At least that's my opinion. So choose which ETF you think is most suitable for you. Then, while continuing to learn about the nuances, you can always switch to another ETF later. And yes, you can buy and sell investments within your TFSA. Just know that registered accounts are not made for day trading. So if you keep buying and selling multiple times throughout the day for short-term profit taking, your account may get flagged. Now your next question might be, so how much to invest in my core layer? Personally, I'm comfortable with around 50 to 70% in this category. That is not a recommendation, that's just how I do it. This means if I had $1,000 to invest, I'd invest $500 to $700 of it into this core layer. Now that that's settled, let's move on to layer 2, growth. Now this layer is different. While the core layer is your basics, the growth layer is where you intentionally add more concentration, meaning you get a bit more specific with your investment choices. The job of this layer is to tilt your portfolio toward areas where you believe there may be a higher long-term growth potential than the broad market. That could mean certain sectors like finance, energy, or telecommunications, or themes like robotics or waste management. So this layer can potentially grow faster than your core over time, but it can also be more volatile and it can underperform for long stretches. You have to be prepared for years or even a decade in some cases. Nothing is guaranteed here. One example of something that could fit into this growth layer and that I have in my TFSA portfolio is tech.to. You can see it here on my Questrade app. Tech.to is a Canadian-listed ETF which basically holds mid to large tech company stocks. So instead of giving you broad market exposure across many sectors and countries, it leans more heavily towards technology-oriented businesses. Other examples are the QQC for more NASDAQ-style exposure or XIT for Canadian tech exposure. If you're interested in the energy sector, there's the VDE, for example, that tracks the performance of oil, gas, and coal companies. So regardless of what sectors or themes you're interested in, you'll find something. By the way, guys, I'm not endorsing any of these ETFs specifically. These are just examples to give you an idea. So for your growth layer, the idea is to pick an ETF or a basket of individual companies you really believe in long term after you've done your research. And this is where I want to slow down for a second because this really matters. Growth is not just random picking. Your reasons for picking a sector or theme should be solid. Maybe you believe digital infrastructure, software, AI, semiconductors, or certain healthcare innovations will keep growing over the long term. Maybe you know about a particular sector better than other people because of your work or your own research even. Or maybe you want to simply be in a part of the economy that you think will be more productive in the future, and that's fine. But the mindset here should still be long-term and intentional, not this went up last month so I'm buying it now. That's a totally different thing. The easiest way to think about these layers is this. While your core layer says, I want to own the whole or at least a major part of the market, your growth layer says, and I also want a bit more of this specific area because I think it has stronger upside. That's why I like the idea of separating this. You stop turning the whole TFSA into one giant concentrated bet. So in case you're wondering how much to put in this growth layer, it's of course totally up to you, but personally, I'm comfortable with putting around 20 to 30% of my TFSA investments into this growth layer. Now let's talk about layer 3. Layer 3, I'd say, is an optional layer. That's a layer you'd use if you're really comfortable with risk. Because here in layer 3 is where I invest in even higher volatility investments. This, you could say, is the most aggressive layer. And by the way, guys, I don't agree with people who say you shouldn't take any risk. I just believe it's important to take calculated risk. That means that you don't put all your 100 eggs into the most risky and most volatile investments, but that you can make a calculated decision on how much risk you can and are willing to take. That's based on your financial situation, your financial responsibilities, your long-term goals, and your general risk tolerance. So if you have barely any savings, have 2 kids going to college soon, and are in debt, then probably don't take too much risk. But if you're young, have a steady income and side hustles and a fat emergency cash account, then you can probably afford taking a bit more risk. So that being said, layer 3 is where I buy more concentrated, specific, or simply more volatile assets than the rest of the portfolio. This contains my stronger bets, you could say. Now, personally for me, that is Bitcoin. If you've watched my videos for a while, you'll know I invest heavily in Bitcoin. But since I can't buy Bitcoin directly in my TFSA in Canada, at least not at the moment, I have to do it another way. For example, buying Bitcoin ETFs instead. For example, the FBTC.to, which is a Bitcoin ETF listed in Canada. But there are many other options, of course, if Bitcoin is not your thing. It could mean investing in one specific company you've researched a lot. Probably something you think is undervalued at the moment and that has high growth potential in the long term. Something that, because it's so volatile, you want to make sure you cap your exposure so you don't invest over a certain percentage. For me, that's, for example, the MSTR stock, a US stock. Now again, I'm not recommending any specific stocks, I'm just telling you what I do. I have a specific reason why I buy MSTR, and that's because I believe in Bitcoin's long-term potential. And MSTR increases my exposure to Bitcoin further. But within my TFSA, I make the amount or the percentage contained by making it my optional or high volatility layer instead of my all-in layer. I'm doing this, buying Bitcoin ETF and MSTR, being totally aware that in the short to medium term, its price can go up and down, even down by 50% or even more for longer stretches of time. And I'm prepared to wait it out because, among others, I have a fat emergency cash stash. So whatever you choose to add to this optional high volatility layer, you need to go in with the same mindset, that it's super volatile and that if you are pressed to sell your investments at a time when it's low, you could lose a lot to all of your money. So while your growth layer says, I want a bit more exposure to an area that I like, for example, energy, high volatility says, I know this can swing hard and I'm intentionally keeping it in a separate bucket so it does not take over the whole account. Personally, I'm comfortable with roughly around 20 to 30% in this high volatility layer. Again, I need to stress this is not financial advice. It is really important that you adjust these percentages according to your own situation. As I said earlier, I'm comfortable with this kind of setup because of my current financial situation, age, time horizon, and risk tolerance. Although I wouldn't like it if, let's say, half of my investments were completely wiped out, I would be okayish, as in I would survive and I'd still have time to build things back again. But if that doesn't apply to you and your life would be in shambles, then definitely dial down the percentage for the growth and especially the high volatility category. Or you might even leave out the optional high volatility category altogether. That is actually one of the best parts of this framework. It gives you a concept for how to structure parts of your investments, and you can completely tailor it according to what you need. Now, no matter who you are, where you're from, make sure that you take care of one thing that can make or break your financial journey, and that is, as I already mentioned, emergency cash. Before you start investing, it's really important that you've built a safety cushion. That way, in case of an emergency, you can dip into that emergency cash account instead of being forced to sell your investments. And yeah, shit happens. Maybe your car breaks down, maybe you lose your income, your roof needs repairs, or you have an unexpected family expense. If at that time the market is up, then good for you. But if it's down and you're forced to sell, then you may lose a lot of your hard-earned and invested money. Your emergency fund protects your investments from your life. I'd say 6 to 12 months of an emergency cash fund would be ideal, but even 3 months is a good start. The ideal number will depend a lot on your job stability, family situation, and fixed expenses, but the main idea is simple. You want a buffer. Now, many people automatically think that you need to have your emergency funds leaving around in a checking account or so. And yes, you can do that. I personally always leave a few $1,000s in my checking or savings account for quick access, but I don't put the bulk of my emergency cash there. Why? It basically earns me nothing and just accumulates dust. So if you want an emergency cash fund that also earns you some interest, some income at the same time, you can also keep it, or at least part of it, inside of your TFSA. For example, in the form of a high interest savings account or money market funds or a GIC. So if you don't have an emergency fund set up yet, you can also build it into your TFSA as part of the core layer. So instead of just ETFs, for example, you could also have one or some GICs. Questrade actually has GICs, and it's easiest to browse through them on their desktop version. For me, Questrade has been a great place to set up my TFSA and invest into those 3 layers I mentioned. I've been using Questrade for almost 2 years now, and I like the fact that there are no fees for buying stocks and ETFs. And they also have GICs, which not all investment platforms have. New customers can even get a $50 cashback at the moment. Check the terms for the latest offer if you use my referral code to open a self-directed investment account and fund that account with at least $250. Note that I may get a small commission in case you use my referral code to open an account. Now, full disclosure, guys, I don't only invest on one platform. I personally like having options and flexibility, so I have my TFSA and RSPs on 2 different investment platforms, including Questrade. So yes, you can have multiple TFSAs, especially if that helps you to separate your investment buckets. So I left my referral code down below, and just in case you need a full step-by-step guide for how to open a TFSA on Questrade, I also made a separate tutorial for that over here. Now here's my question for you guys. If you divided your TFSA into 3 buckets, core, growth, and optional high volatility, what percentage and what specifically would you put in each one? There's no one perfect answer, guys, but that would be a really interesting discussion. Let me know in the comments down below. I'd really love to hear from you. And just in case you want to know what my favorite ETFs are, then join me in this video next.